This is a very, I know it's your style.
Yeah.
More academic, from the University of Wisconsin, Da Lee and Timothy J. Ridio.
Yeah.
The piece is persistently poor performance in private equity real estate. Boom, shot across the bow, Matt.
That's what we do.
That is what we do. Why is the performance so persistently poor?
That's what I said. This paper has a real throwing down the gauntlet thing going on.
Yeah.
I picked it because I'm drawn to things like this. This confrontational paper, it's an academic paper. It's incredibly relevant. Regardless of what they say, I'm going to dig into it. And I think that there's some valuable insights into this. And it doesn't necessarily say like, okay, get out of private real estate.
Yeah, it doesn't say real estate is bad. It makes some really interesting observations about kind of the nature of the deals and the asset classes and the managers and the investors that invest in them that lead to this.
It's much more like a structural thing, I think, than it is saying like, okay, there are problems here. The market's going bad. It is examining the incentives and the kind of processes that are in place that are affecting what they think should be a survival of the fittest.
Yeah.
And
it's really not.
Yeah.
It's really not. So I just want to read the abstract, Matt, so that we compare buyout or BO, venture capital, and private equity real estate funds. RE funds underperform buyout and venture capital as well as the public market alternative. In real estate, worst performing fund managers survive at a high rate. They are also susceptible to economies of fund scale with no skill-based persistence to offset the negative scale effects. Analysis of noisy fund manager selection indicates that RE or real estate investors are not disadvantaged relative to BO, buyout, and venture capital. LP investors in real estate funds seem to be optimizing something other than or in addition to investment return when selecting fund managers. So they're saying that it's not really just about the returns. They're looking, and it's just so true because investing is as quantitative as we want it to be. You can't ignore that it's an emotional exercise. People have emotional drives that are underlying the reasons why they're doing things relative to their fears, hopes, and desires. And certainly, I know many people are attracted to real estate from a standpoint of preservation, wealth preservation, taking a more conservative approach and a more steady, consistent approach rather than a typical investor in a venture capital fund that is looking to take max risk, looking for max returns.
Yep.
And so it's a little bit, and Matt, I haven't read the whole piece yet. It's 50 pages. I'm going to read the whole thing.
I suggest people skip to page 34.
Yeah. But I want to hear your analysis.
Yes.
And from our discussions, I want to talk about some of the structural underpinnings.
Yeah. And I really would like, so there's, it does get very heady, and it only really started to make sense to me on page 34 where they set up why they think, things are, their metrics of how venture capital is performing, how buyouts are performing, and but they kind of justify why they think these things are happening. And their general thesis is that real estate funds do worse than venture capital or buyout funds because there's not a lot of whole performance gains from fund 1 to fund 7 or whatever. The VC unicorn can build knowledge and relationships and a network that could bring higher returns. So that's the venture capital advantage. The buyout specialist could master the financial engineering and organizational best practices that can transfer from one company to the other. But this paper's authors argue that this growing acumen is largely absent in the real estate world. Funds for real estate are as good in fund 1 as they are good in fund 12 or 7 or whatever.
Or even maybe not as good.
Maybe even not as good. And there is an idea with this diseconomy of scale that, you identify all your opportunities, all your real estate opportunities, and the well's dry. And they talk about how, you could do what they call, you could bring in a local sharpshooter, someone with local knowledge, but that guy's going to ask for a fee. So that's going to cut down on your returns anyways. You could do a value add or opportunity strategy. But they say that there are frictions that are substantial that that are going to cut into your returns. They say these local sharpshooters could help you either get favorable political some favorable policy, or they could just know where everything is in the players.
And so is really what they're saying is there's an advantage to, I guess, smaller, maybe more nimble operators that are more niche focused that can go after, they say, sharpshooters after going after specific deals, rather than comparing to like the Blackstones or very large firms. And it makes sense. It makes sense in all asset classes. Not just real estate, that as your AUM, your assets under management grow, you have more money to allocate, and the pool of deals may or may not have grown. That's especially true. It's across the board, but with real estate, I mean, the deals, they don't scale like exponentially, like, maybe like tech companies, maybe some VC firms. It's like, the deal sizes are like, you can go from doing, $5 million to $10 million, and there's $100 million deals, but like, outside of that, like there's not very many $100 million deals, like of a particular asset.
One thing that I noticed, even just hopping on board Great Capital, was the deals that we're bidding on. These are not like a commodity where everyone needs them. There are maybe a small handful of bidders, of serious bidders for any opportunity.
That's 2023 versus 2020.
Yeah. Yeah. But again, like, it's not like there are people that are always, that there's not a huge number of players that are going to buy, and there is a very finite amount of opportunities, period.
Yeah, I think that the range is much more narrowly defined.
Yeah.
It's like the deal sizes are, if you're in a private equity space and you're at real, managing capital that's anywhere between, 10 and a couple $100 million, and you're looking at deals, call it 10 million to really maybe $75 million. But there's only so many of those.
Yeah.
And so that the deal size is kind of blocked off, but also, kind of that, the returns are also in a more narrow box.
Yes.
Like there's not as much volatility. Like you can get, it's, call it on a not great real estate deal, a high single digits IRR to a, call it 20, 30% IRR, but it's within that range. Whereas like, but typically maybe even a smaller range. Maybe it's 12 to 18 is your typical median IRR range for real estate. 15 is kind of the target.
That's what they say in the paper.
Yeah, but for VC, I mean, you may be targeting, some may be at zero. You're going to take a loss.
Yeah.
Some are going to be, 1,000% IRR. And so that's that scalability, the range and volatility of return outcomes.
Yeah.
And, you could be looking at buying a $5 million company that you're going to hope blows up in an early seed round that blows up to $1 billion company, or you can buy a $1 billion company that you hope to take it to, $10 billion. So there's such a wider range and opportunity to kind of scale that investment business. Yeah.
And that was their big thing, I think, was scalability, but also they were like, well, what are the pressures? The selection pressures for VC and VO. It is largely survival of the fittest. We're going to pick the best. It quickly hones down on the major players that have these competitive advantages, and people invest money into the winners.
And it goes boom, boom, because one winner leads to the next winner. And it kind of leads off each other. Where real estate, it's not. There's not that inherent, I guess, momentum from one deal to the next. Other than like, hey, we bought a deal, and maybe some people know us, we're buying the deal, but it's not like you're gonna. I mean, there are some advantages, but maybe not as pronounced as in the tech and VC space.
And then the argument here, and what really this almost boils down to, is risk, is consistency and risk. Now, when we're talking about demands, what are they demanding of these real estate investors? Consistency. They said that they talked about an illiquidity premium, and they put premium in italics, not a liquidity premium, but an illiquidity premium. I forget which one was in italics, but they wanted to emphasize it. And they're like, this is backwards. But these pension funds are the number one investor in real estate, or they are a big investor. They're a big force that determines which of these are winners and losers. And the winners are the ones that can deliver a sense of consistency and a sense of that things are maybe less risky.
Well, if you think about it, and that's a great point. I'm really glad they had in the article, and you brought it up, Matt, is the big dollars in real estate are from institutions. It's pension funds,
Mhm.
insurance companies, and the like. And if you think about the way they operate, they're very conservative. Once they kind of have their sponsors, like they've got their stable of operators,
Mhm.
they kind of stick with them for a while. They maintain those relationships.
Yep.
Because it takes so long to kind of vet everyone and get comfortable. Because trust, and again, it's the other reasons besides returns. It's that sense of stability and safety, and
Yeah.
a lot of that is through building the personal relationships and building up trust with these operators.
Mhm.
And so you're like, I don't know if I want to go out and and take a risk on another company that maybe they can squeeze out a little bit higher returns, but one, do I want to take the time to do it? And like two, like I know these guys, and that's why Blackstone's so popular.
Yeah.
There's a little bit of like, hey, well, this respectable firm's investing in this Blackstone fund.
Mhm.
Why not us? It's we might not get the highest rate of return, but when our clients ask us what we're doing, and if they say we messed up, we'll be like, well, everyone is investing in the Blackstone fund or all these other large funds
Yeah.
that have a great pedigree, because I think there's an assumption of, well, yeah, of course it's good. Some these guys, I'm sure, did the due diligence.
Yeah.
If these guys are investing with them, they're good.
Yeah.
So you leave a lot on the table, whereas I think maybe the profile of a VC investor is a little bit more opportunistic and really looking at maximizing their return. Rather than like, well, I want to, make sure I'm diversified and have a good.
Mhm.
Real estate investors are much more conservative, I would think, on average than your
Yeah. Kind of like preservation and growth, but a little bit more towards preservation. Yeah.
So it's the, I guess my conclusion, or is it the investment managers, or it's really the investors, and the investors not keeping the investment managers accountable and not looking for new managers to maintain those level of returns.
And that's what I was
complacency.
and that's what I was thinking too. Is not just selection of real estate private equity over venture capital or buyout private equity firms. I'm thinking of, well, within the real estate space, what is valued, because their argument is kind of that the cream isn't rising to the top in the real estate space.
What they're saying is like, you all keep rewarding people who are doing an average job and they're not doing as good, and you just keep rewarding them for doing an average job.
And that's a structural thing. And it doesn't mean that any private equity, that means that there's a lot of variability when it comes to private equity real estate.
And then not all is the same.
Yeah.
And just looking at some of their their charts and their conclusions, Matt, I think Gray Capital may be in the absolute sweet spot of like,
I know, that's right.
I mean, honestly, I was looking through, because you obviously want someone experienced that's done enough deals,
Mhm.
but they started to identify like after that, like kind of like fourth, fifth, sixth fund, like there's seems to be some tailoring off of returns, and it kind of flattens out, and it's because, again, like when I'm looking to buy 4 deals a year, I can make sure that they're the best 4 deals that's on the market. If I need to buy 40 deals to even accomplish that task, you're going to have to start making some compromises, and then you all of a sudden start making exceptions of like, well, this one's going to maybe return a little better, or this one's going to be under, but they're going to
because you can't control what those 40 deals are.
No, how much detail can one person go in? So there's so many variables that kind of go into that process.
Yeah.
And you can see why versus a VC firm that's like, well, yeah, I'm still going to try to do 4 deals, but they're going to be 4 deals that are 10 times like the size.
Yeah. And I've been incubating these people for so long and building, and I know just the right people.
Yeah. I think that I don't think that's as much. I could see how that could play into it a little bit of like, okay, I'm in with one founder and he's just like a rock star and go to the next. But like that also, I think, is a factor in real estate as well.
I was going to say,
because we've experienced that, just, I mean, anecdotally, of doing well on one deal or doing one deal leads to more relationships and building those relationships.
I was going to say that too.
Brokers.
Even if just like property management, like it's almost discounting the idea. Well, like, no, you can kind of master your craft on your first fund and do better in your second if you figure things out. If you figure out how better to operate, if you figure out you're painting your units too much, or you're charging too much at least, and there are some insights that are gained.
Yeah.
It may not be the crazy financial engineering that they're talking about with a buyout private equity, but it's still something.
I think fund 2, fund 3 seem to be the real sweet spot of life. Those are the gangbusters.
Yeah.
So it's interesting, and I think it again, it goes to show that you need to be specific on finding. There's a lot of average sponsors that are really good, but they may be at a scale where it's hard to deliver the same returns. So one, past returns aren't necessarily an indication of future.
Yeah.
And you need to bring that into your equation of, okay, yeah, we want you to be the right size, but we also want you to be too big of where, you're not going to be making
it's a bad headline, but man, it does give you a really good roadmap to like, okay, this is how you pick a private equity real estate person. Pick someone that's maybe past their first one or two, but they're not sleepy.
I think the same paper could have been written with a different title of like not all real estate like the divergence of of like real estate sponsors.
Yeah.
I think if you broke down the different types of operators and their size, I think that would be a really interesting comparison also.
Yeah, that would be really interesting. So not all, you got to read the report. Maybe it's a little bit more than the headline.
No, just stick around for the Gray Report.
Because man, that is the cheat sheet. You look for a private equity real estate fund manager that has some experience, but not too much, and that's it. There's the sweet spot.